Thank you, everybody, for coming to the second meeting of Healthcare Workers for Fi. Sorry about the cancellation last time. With the wedding coming up, it was a little bit hard to get everything ready and the work schedule. So I'm going to try to do this every month. So forgive me for missing that one. And with the next coming months, there may be some times with my ICU schedule that's going to be a little bit tough, but we'll try to make it work. Make sure to mute yourself if you haven't already muted yourself. And again, this will be recorded and put onto YouTube. I'm going to edit it, splice it down a little bit, just like last time. So it'll be a little more seamless. If I go too fast today, please let me know. And if any questions, feel free to stop me. We can hold on for a second, talk about something, or we can wait till the end. You can always feel free to email me. And if anybody is new and wasn't on the first meeting, if they don't mind just putting in the chat their email address, and then I could add them to the listserv later. I'll move that out of the way. So the objectives of today are just talk about a summary of last time. Start talking about types of returns, simple versus complex, compound interest, places to grow your money, intro to stock and bond investing, active versus passive funds, and then asset allocation, and a portfolio tracker that I really like to use that I'll show you. Last time we didn't get into the nitty gritty, but this time I'll start to show you what I use and how to make this pretty easy. First, I wanted to ask everybody, what did you do in the last month to ensure the success of your financial future? I'll start. So what I've done in the last month is I made a Roth conversion, and it's probably the best time to do that. I haven't even talked about that yet, but I'm in my lower earnings years, and I don't know what's going to happen with the new bill that's in the Senate right now. It might go away. The backdoor Roth IRA might go away. So I did a little bit of a conversion now before the end of the year. I also invested another small chunk of money in my self-directed IRA into a private crowdfunding REIT called Streetwise. I'm not an accredited investor yet, so I can't do any syndications, but did my research on it, and they invest in some commercial assets. I think they own a commercial sort of big plot in it's St. Louis that has a Panera in it, FedEx in it, and they've been getting pretty good returns, about 8 to 10% back to the investor. Which is essentially you can reinvest the dividends too through a pretty easy in the last month. Anyone on here want to share what they've done in the last month? Just anything, small or big.
Well, I know me and Tyler worked on some Excel sheets since we're still in school. I just graduated, but he's obviously still going. Spreadsheets just for allocating like our salaries for the first few years out of school, so we can kind of tackle the debt that we had to accumulate for school and kind of catch up on our retirement fund. So that's kind of it for now until I get a paycheck from Vandy.
That's awesome. And congratulations, Lance, for getting a job at Vandy. It's awesome that you're doing that, because a lot of people I talked about that we always have to track where you are, and you never know where you are. You never know where to go if you don't know where you are right now. So to know where your debt is, your assets, your liabilities is going to be important. Oh, and Anna tells me you just graduated, right?
Yes, sir. Yep.
Oh, congrats on that too.
Appreciate it, man.
Anyone else on here? Anything happened in the last month that you've done financially or anything to kind of move you forward a little bit? All right, well, we're going to talk about some things today. I wanted to summarize a little bit the formula from last time. This was sort of combined from a couple of places, but remember, we want to aim for a target. I think I was just talking about that. That's kind of the best way for you to know where you are, where you want to be, what number you want, have a way to track it, Excel files, personal capital, Mint, and I'll show you one today that's a good portfolio tracker. Have a scalable income source, your offense. So your W-2 income as a healthcare worker is going to be very important to help you build against inflation, against your debt, and help you essentially build that retirement account that's going to, once you retire, kind of take care of everything for you so you can scale back. And remember, retirement's not the answer all the time. It's just financial independence, so you can do what you want, if it's medicine or anything else. Live below your means. This is always, they go together with offense and defense here. This is something that I think the white coat investor always talks about, live like a resident for the first couple of years. And you always want to make sure that you don't give in to lifestyle inflation. You always keep an eye on where you're at and grow your liabilities over time, but to make sure that your assets and your income far offset that, so you can grow your nest egg and put even 10, 15, 20, 30, or 50% if you're a hyper saver into retirement accounts and assets. Right into that, yeah, buy assets. Try not to buy many liabilities. We mentioned last time, if it's a car, buy a used car, or something that is just not going to set you back a lot. Pay off that credit card debt. Buy things that will appreciate through time, real estate, investment, stocks. Don't buy things that are just going to put you back year after year and not help you get to your goal. Stair step those assets. So if you start small and then scale upwards. You don't have to go from 0 to 100. In the real estate world, you don't start with an apartment complex. You buy one house, two house, three house. With your stock portfolio, you're not going to be at $1 million in assets tomorrow. You're going to dollar cost average, buy every month, max out those accounts every year to get to your goal. And then with that, you always want to harness synergy. So really what this means is know what you're good at and embrace it to help you grow. And this can be in medicine, this could be in side gigs, but really know your strengths. And then always get around people who think the same as you, because that's why you're here. Those that want the same things, they'll push you, you'll grow with it. And you can rely on those folks to be your cheerleaders all the way to financial freedom. Commit to continuing to improve in the pursuit of excellence. So this is why you're here again, but it's the same thing in medicine. You study all day, you go through the years of training. If it's CRNA, if it's nursing, if it's medicine, it's anything, you're doing the same thing, and do with your financial education, just continue to read. And then finally, give back. The more you give back, the more will come your way. So that's a good summary of last time. And this is sort of what we talked about in a nutshell last time. I'm not going to go to these in detail, but just to reiterate some of the investment vehicles that'll help you grow. We talked a little bit about the taxable account, where gains and dividends are taxed at all times. Your Roth IRA, which is going to be the best workhorse for you, taxed before entry, grows tax-free and taken out tax-free. Your traditional IRA is pre-tax in, grows tax-free and taxed on the way out. So that's different than your Roth. This is called a pre-tax account. All of these sort of word soup here, or number soup here, your 401ks, 403bs, solo 401ks, work similar to that traditional with different limits, and they're more workplace plans. Pre-tax in, grows tax-free, taxed on the way out. Your Roth 401k, this is where we mentioned it gets tricky and it's a little bit different. It functions just like a Roth, though it's from your workplace a lot of the time. Taxed before entry, grows tax-free, taken out tax-free. These accounts you're rarely going to see, but you might if you go into private practice or another workplace, or you're not in medicine. The SEP here, which is mostly funded by your employer, up to 25% of the earned income, and it's pre-tax. Your simple account here, simple IRA, which is funded primarily by the employee with a little bit from the employer here. And then your HSA, which is the best account, and we'll have a whole lecture on that. It's your stealth IRA because it's triple tax savings. So if you can get it, you do need a high deductible health plan, but it's pre-tax in, so that money every year is deducted from your taxes. It grows tax-free, and then you can take it out tax-free for medical expenses. And if it's not for medical expenses, then you do get taxed on it. But there are many different ways to kind of work that plan to make it the best for you. And that's why I want to spend a whole sort of session talking about that in the future. Last time I didn't talk about this. I'll just throw this in here before we move on. Don't forget about the kids. So the 529 plan is a state-sponsored plan to help your kids save for college. It's after-tax money, which grows tax-free. And if you spend it on legitimate educational expenses, which I'm not really sure what would qualify as legitimate, but I'm sure medical school, books, things like that, dorm, comes out of the account tax-free. And an individual can put up to $15,000 a year into that, or $30,000 for a married couple. You can also, I've learned, get a tax credit based off what state you live in. Don't think Tennessee offers a tax deduction or a tax credit, but your state might, or other states will. And then these other plans are similar, but they don't have the same tax breaks, the Cloverdale, educational IRA. So the 529 is probably your best vehicle if you want to invest, which you can invest in index funds in it, just like we're doing these other accounts, but save for your kids' college and have tax-free growth. So really what I wanted to spend today about was how do I grow money? And the goal should be your money makes you money. So there's really two ways your money can grow, the ways return can happen. One is through capital appreciation. Capital appreciation is a rise in the investment's market price. So it's the difference between the purchase price and the selling price of an investment. So if you buy something worth $10 today and you sell it for $20 later, you profit $10, that $10 is the capital appreciation on that. Income payments, also called yield or dividend, these are all sort of the same word here, is if you buy an asset or lend someone money, they'll pay you back at an agreed upon interest rate at a frequent basis, at a later time. And the dividends are what we hear about in the stock market. So if you buy stocks, some stocks pay you either quarterly or yearly. Same thing with rental payments on real estate. So you get the cash flow every month from the rental income. That's the same thing. Payments on private notes. If you lend somebody money, they're going to pay you back a dividend or an income payment. Bond interest rates and CD payments, which we'll talk about. But your overall return needs to make up a combination of these two. So when you, for example, let's say you buy a home and you sell it, it's going to appreciate over time. If it's a rental property, you would have gotten the income payments and the capital appreciation. Same with the stock. If you buy like Tesla stock today and you sell it years down the line, who knows where it's going to be. But if it goes up, you're going to get the capital appreciation based off the difference of what you bought it at, the basis, and what you sold it at, plus all the dividends in there. The Tesla stock's a bad example because it doesn't really pay a dividend, but certain stocks will do that. Then they could be substantial, so the combination of the two could equal a good total return. With that goes hand in hand, and what's the difference between compound versus simple interest? So simple interest is pretty simple to understand in the sense of it's just interest on principal only. So I took this from this basics mathematics, and I think this is a good example here. $200 invested with a rate of 3% for 2 years with simple interest is just 3% off of that 200. So it's $6 the first year, $6 the second year, $6 the third year, $6 the fourth year, and so on. Compound interest is much more powerful in that it's interest on principal and interest previously earned. So $200 invested with a rate of 3% for 2 years, $6. But then the next year you add that 6 to the 200, and then there's interest of 3% off the 206, which is 618. Total interest here $12.18. But then that $6 is added back to the 206. In the third year, it's 3% off of that, and that just continues to grow. So what we're going to talk about next is really compound interest is the best way to grow your money, but simple interest has its place. A lot of things only function on simple interest, and you can get a good return from that too, but compound interest is going to be your workhorse. That's how you're going to grow your money the fastest, and that's how I'm going to show you you can essentially get to that number we were talking about last time very quickly. So this is from the last lecture we talked about based off compound interest. Let's say you were to invest $6,000 today, age 30, and you want to retire by 65, assuming a 7% expected rate of return, which this can go up and down depending on the year you're on, inflation, but let's say it averages out to 7 with a marginal tax rate of 24, and that could change too, but based off what you're taking out for that year. The contribution is going to be 210,000, but your growth is going to be 887,481. In a Roth account, this is in a Roth account versus a taxable account too, which will show you this is what you're going to get in the Roth account. But because of the tax drag in a taxable account, just like a regular brokerage, not a retirement account, that's still a substantial difference of about $200,000 there. But you can still see in both cases, compound interest really favored both of these accounts, the Roth more than the taxable, and how you can exponentially grow $6,000 over about 35 years. And this is, if you do more than that, it's going to happen faster. You're going to grow substantially more than that. So that's why Albert Einstein said compound interest is the 8th wonder of the world, because it really is, and it's a powerful tool. And really the rule of 72 it's one of those quick rules that, like we talked about last time with the 4% rule, or trying to figure out the number to retire on. It's just a quick way to figure out how long it'll take to double your money with compound interest at a set interest rate. So the rule says that to find the number of years required to double your money at a given interest rate, you just divide the interest rate into 72. So let's say you want to know how long it takes to double your money at 8% interest rate, assuming that 8% is stable, that compounds. We're not talking about simple interest. You just divide 8 into 72, and you get 9 years. How long will it take if you get a 1% interest rate to double your money? Anybody?
72 years.
72. Yep, you got it. So that's really the power of understanding this is big, because if you're making a 1% interest rate, it's going to take you 72 years to double your money. So what is a good return? Well, I think it's first important to understand, before we get into that, what inflation is. And I didn't understand it for the longest time, but it's becoming increasingly more important because you're hearing it everywhere in the news, and it's at the highest it's been in a long time. So this is from the site that looks at graphs and looks at weekly reports and monthly reports based off the consumer price index and what's going on based off the Federal Reserve interest rates. But these are the percent inflation that we're experiencing month by month since October of 2020. And in October of 2021, so 2 months ago, inflation was at 6.2% based off what it was last year at the same time of 1.2%. And what inflation really means, it's a fancy way of saying our currency, in this case the US dollar, is becoming less valuable each year with less purchasing power. And really, it's a complex dynamic of how our economy is running. It is unavoidable in a sense, but there's a lot of situations in the last year that have led to it getting to this level. And some of these things, and I don't want to get political here, just to tell you what goes into inflation, is one is called cost push inflation. Cost of businesses rise, and that cost gets pushed into the customer at that point. The business improves technology, for example, workers demand more pay, there's resource limitations, supply chain issues such as with COVID. A lot of that gets pushed from the business into the workers, back down to the consumer, and that raises prices. You have demand inflation, where demand cannot keep up with supply. We're seeing that a lot right now. And that's a factor of a lot of things. The consumer has more disposable income, and that's a factor of people are staying home, working tech jobs. Even though wages are not really matching some of this, some jobs are making a lot more than others, and wages are going up in some fields versus other fields. There's an increased demand to buy things, stimulus checks. You combine this with the ability to take out a loan to buy the cool things you want at low interest rates, and that leads to a wild spending spree. And then you combine that with something like real estate that is a limited resource, and you get a bidding war, overinflated prices, and that just leads to the sort of the situation we're in now. The final thing is, though, you have governments printing money. This is a problem all over the world. And when the government does this, it tries to stimulate the economy, increase cash in circulation, tries to pay for new bills that are coming out, the increasing deficits. And every time you print new money, that decreases the purchasing power of the dollar. So that really makes it hard for that W-2 income you guys earn to go anywhere if you don't invest it, because every paycheck you get is becoming less valuable month after month because of all of these factors working together. And I thought, it's always good to see numbers. This is a good example of if you bought something for $10,000 today, if you bought that same item in October or November of 2020, it would have costed you $9,434. So the item is the same item. Whatever you bought for the 10 grand is the same item, but you're going to need more money to purchase that item. So your dollar is worth less. This can apply to food, cars, homes, computers, Starbucks coffee, anything. And this is why it's important to understand where's a good place to hold your money versus places to invest your money. So places to hold your money. And does anyone have any questions on that before I move on? I know That's a little bit of a complex topic, and I didn't want to go too far into it, but I just wanted to introduce everybody to it. Cool. Feel free to stop me if I'm going too fast. So, places to hold your money, bad returns that don't beat inflation. A checking account. I know this sounds simple, but a checking account is a deposit account where you just put money into it, but it doesn't earn any interest on it. Great place to hold money. Your W-2 paycheck goes into it. You can write checks from it. You can transfer money to other accounts. A savings account used to be a lot better than it is. So a savings account is an interest-bearing account held at a bank or financial institution. It's a place that can easily link to your checking account. It's fast and easy. You can put large sums of money into it that are federally insured, but they pay very low interest rates. I'm talking less than 1% nowadays. And this really makes it hard to beat inflation. It's something too that some banks require a minimum balance for it. You get charged on it. So if you're getting charged a fee on it and you're already making such little interest, it doesn't make much sense. But then there's this other account that makes sound a little bit better, right? A high yield savings account. This is not much better in terms of its interest rate. I think it used to be maybe up to 2%. And when I opened one through Capital One, I have a couple of them that are good emergency fund accounts that I just can hold things in. But really, the interest rates now are less than 1% on them. And they used to be a lot more popular than they are. These places, again, are good places to hold money. You're not going to grow any money on it. Something a lot of people too mention is, what about a money market account? Money market accounts are similar to high yield savings accounts, where they used to be a lot more popular than I think they are. And they are interest bearing. Again, a good place to hold your money. You can write checks from it. They may even give you a debit card from it. They may be linked to your brokerage account just to transiently hold money, but they're very low interest rates. And I pulled this too. You're looking at right here, 0.25 from Axos here, and then 0.25 to 0.85% with a minimum of $1,000 balance for this one. So again, this is not where you're going to get to if you remember the rule of 72, as Tyler mentioned. 72 years, you're less than 1%. It's going to be more than 72 years if you're trying to grow your money in these accounts. This CDs was something also that I heard about a lot growing up, but not really much anymore. And what a CD is, it's not that CD. Also, if anyone had that CD, it was good in 1990, but not now. So a CD is an account that you can use to save money for a set period of time. You open the CD, you say how much you want in the CD and how long you want to keep it in there, but they'll usually tell you it's got to be 5 years, 10 years, 15 years. And then you cannot take that money out for that period of time, and you'll get a set interest rate that's fixed for that period of time, and then all your money back out once the CD is over. And if you're looking at the returns, it's really not much better than a high yield savings account. And I've looked through 5, 10-year, 15-year CDs. It's not even a viable conversation anymore to beat inflation. It's not even really a good place to hold your money because it's locked in. So it's not really liquid either. So I would not even recommend thinking about CDs. And this is from the Money Guy show, so I'm going to give them good credit here, because they looked at somebody who was investing in a CD versus the Fidelity Magellan Fund from 1985 to 2000 and just keeping it ongoing in a CD ladder or continuous CDs. And the difference between the two in the year 2000, it's just crazy how if you think a CD is going to grow your money compared to a index fund. And then in summary, to think about all these accounts together, checking accounts, savings accounts, high yields, they're places to park your money, but not necessarily grow them because they cannot beat inflation or compound your money fast enough. Let's say you put $10,000 in today at 0.4 annual interest per year. That's $40 of interest per $10,000. With the rule of 72, that 10K would double to 20K in 180 years. So this is a question that it may seem simple, but it's kind of complex in that what's better, a 10% return or a 6% return? And you may be saying, obviously, a 10% return. But the question you should be asking is what return is right for you? And the things that influence your return can be a couple of things. So the ability to beat inflation, like I said, a 10% return with an inflation rate of 8% is not as good as a return of 6% with an inflation rate of 2%. Taxes and fees. So what account you hold these investments in, as I talked about, that this is tax drag, even though you don't realize it, is going to put a big damper into your overall retirement nest egg. And we'll talk about this in a subsequent lecture on this, is which accounts to max out, how to optimize your taxes and fees. Fees especially, we'll get into today with expense ratios. Having an active manager manage your investments could really hinder your return. The market and the economy situation. So where are we at right now? Is this 2008? Are we looking at a bear market, a bull market? The Great Depression? Was it 2021 when the S&P 500 was returning 26% over the year? And that's really going to affect things. Emotion is one of the, I think, the biggest things that's been talked about over the last 100 years, and risk tolerance as they go together. And it's really, you have to understand what's your risk tolerance in investing in more volatile assets that will fluctuate with time. If you are somebody that is going to want to sell at the bottom, then you got to know that and invest in the right thing to prevent you from selling at the bottom, knowing that the investments may go back up. And just seeing your negative returns is enough to make you just freak out and know that your retirement's done for. You have to know yourself, essentially. And with risk tolerance, that goes into your asset allocation. How much do you want in these risky assets? If you're somebody that, doesn't want to see your portfolio completely crash like in 2008, then you don't want all stocks. You want some bonds in there. And if you're somebody that doesn't want to deal with the day-to-day hassles of real estate, property managers, and dealing with, let's say, if something doesn't appraise well or your tenant doesn't pay you, then you don't want to do active real estate. You may want to do more passive real estate where someone else is managing that. So investments that generally will beat inflation right now are passively managed index funds, owning the stock market. This only really works if you do this passively in the sense of index funds without an active manager, which we'll talk about. And you're banking on a combination mostly of capital appreciation, but reinvestment of dividends and growth that compounds, and holding for the long term. The next thing would be Treasury inflation protected securities, or TIPS or I bonds. These in itself technically beat inflation or match inflation because that's what they're designed to do. The returns are not going to be as high as owning more just stocks in themselves. But especially with I bonds right now, these are bonds that are paying 7% that are fixed for a couple of months, but these fluctuate with inflation. They will go down over time. And TIPS are a type of bonds that are matching inflation right now around 6%, but those will go down if inflation goes down. Real estate direct ownership and flipping, I mentioned this is one of the more active forms with a higher risk. You have the ability to get both capital appreciation, high cash on cash returns because of leverage, and you're able to take out money to buy things without your money, so the returns are going to be greater. Cons to this: labor intensive, and you can't just do it from your smartphone. The market can change. And as we've seen right now, it's hard to buy properties with the bidding war, hard to find deals. Real estate passive. So there's ways to get good returns there that'll beat inflation. One of the lower end ones would be a publicly traded REIT. And we'll talk about this at more depth another time. But this is you buying a company on the stock market that buys real estate and that publicly trades. Maybe it gets 5 to 6%. Note lending. So I mentioned this a little bit last time too, was those that have lent to me for real estate deals, and I have 4 people right now, they're getting anywhere from 8 to 12% secured against the property. And this is a good stable return that's set over really 6, 8 months, a year. You can even do it longer. Crowdfunding, this is when you, instead of a REIT, it's not publicly traded, but you invest in a company that buys commercial real estate. Usually have to do this through their platform, and this can be volatile in the sense of, if what their plan was doesn't work, your returns will not be as good, or maybe even negative has happened, but 8 to 20% can be typical. Syndications and limited partnerships, you have to be an accredited investor, which means, I'll talk about this more later, but you have to make a certain amount of money which is I think over $200,000 for 2 years in a row. And this is investing with a large firm that buys big real estate. You don't have much of a role. You're a limited partner. You just invest money, but you can get great returns with this 18% plus. And then we get to the maybe category here. So individual stocks and option tradings. Theoretically, if you're good, Wolf of Wall Street style, you may be able to do it, but I'll show you over time, people that have done this and actively people that are picking stocks cannot really beat indexed investing. And it can be just for a short time that you reach some success, and it's hard to know, like gambling, when you're going to get out. Cryptocurrency. So I think cryptocurrency is a good small part of a portfolio. It's very new. It has essentially had more than 200% returns over the last 5 years, certain ones better coins than others. But I would limit these things to a small portion of your portfolio because if they're volatile, you don't know where they're tracking. It's not like an index fund where you're buying all of them. One goes up, one goes down. And especially right now with the ways you can buy them, it can be tricky security-wise, losing your keys, over investing in cryptocurrency and less in these other assets. If there's a crash or what you picked to invest in goes down, it's only capital appreciation in this sense. All of it's gone. You're not getting cash flow like in real estate, and that essentially what you were banking on to replace some of your income when you're to sell it all is just gone, annihilated at that point. So do it smart. I recommend something like an app like Celsius, which actually I just learned about. They can reinvest some of your Bitcoin. It's sort of like a dividend, and it can compound itself in a way. And then whenever there's an index fund that comes out for something like crypto, I think it'd be valuable. But make sure to do your research. Gold and commodities are the same thing. Gold fluctuates. Some people believe that as the dollar gets less valuable, gold will continue maybe to improve a little bit because it's still a tangible asset. We're not just printing gold. But these are things that I recommend. Keep it a small part of your portfolio, less than 10%, while the rest of these are even more. And this is just to show you the market report. This is from the White Coat Investors. I think it's maybe monthly email. And it shows you that US stocks this year are at 26.49% return. And if you break these down into individual components like value and growth, you'll see that they pretty much track with it. But in the situation we're in now, bonds are not performing well, even negative. And then you're seeing commodities here. Gold is a little bit less, but Bitcoin's at 100% here. Tips I mentioned is matching right about inflation. So you have to understand that this year, like we were talking about last time, doesn't match all years, and there's going to be ups, there's going to be downs, and you have to have a good balanced portfolio to withstand those ups and downs to get the average mean return for these investments. So your goal should be to invest in things that hedge against inflation, are protected against tax drag, that compound with consistency in a diversified way to get you to FI. And I really want to just spend today talking about the stock market thing. So stocks represent partial ownership or equity in a company. When you buy stock, you're actually purchasing a tiny slice of the company, just a share. And let's say the company has a stock price of $50 per share, and you invest $2,500, that's 50 shares for $50 each. So you're a partial owner of that company, but with that, the success of that company, if it goes up, your success goes up. If it's down, you go down, and that goes with your capital appreciation and potentially dividend yield. But remember, not all stocks offer this, and it's very low for most stocks, not enough to replace your income where you could retire easily unless you load your entire portfolio up with individual stocks that pay high dividends, which some people do, but there's a lot of risk with that. Bonds are a loan from a company or the government. Essentially, you're giving the company or a government a loan, and they issue a coupon to you. They actually used to be real coupons. This is an example of an old one. And they are indebted to you, and they will pay you an interest on that loan for a set period of time. And once it's up, they'll pay you back whatever you invested, and then you've made that interest over that period of time. So let's say you buy a bond for $2,500 and it pays you 2% annually, simple interest for 10 years. That means every year you'd receive $50 in interest, which is typically distributed evenly throughout the year. And after 10 years, you would have earned $500 in interest. and you'd get back your initial investment of $2,500. This is not really how a bond fund works, because you can reinvest and that compounds on itself. But this is how, in the traditional sense, an old coupon bond note works. And then, we really don't see that as much anymore. And that now is pulled forward into bond funds. So stocks and bonds tend to have an inverse relationship in terms of price. When stock prices rise, bond prices fall. And historically, stock prices are rising. More people want to buy, capitalize on that growth. Bond prices fall with that, usually in higher inflationary environments to offset inflation. But conversely, when stock prices are falling and investors want to turn the traditional low risk, low return investments like bonds, they want to turn to those things. Bond demand increases, bond prices rise, and stock prices continue to fall. So it's sort of a thing that drives itself, and it self-perpetuates itself. And you may be asking, so how do I get into this stuff? How do I buy stocks? How do I buy bonds? I know this may seem, again, simple in itself, but for especially the early person in the healthcare field or just starting to make an income, they may not know these things. So I think it's important to understand how you can do it and the way I recommend doing it. And many financial experts, like I mentioned, the White Coat Investor, Physician on Fire, and we'll talk about a little bit too, why they've harped so much on funds versus individual stocks. So the way you can buy these things are in the vehicles, retirement accounts, taxable 529s, through a broker, Fidelity, Charles Schwab, Prudential, Vanguard, TD Ameritrade. M1 is a new online platform where you can buy fractional shares. Robinhood, everyone knows too, similar. Individually or through a fund, these are two different ways. So individually is like you just buy the share of the company, and a fund, which we'll talk about next, is you're buying a group of stocks or bonds together. They can either be managed actively by a broker or passively with your input in an online brokerage. And then buying entire shares or partial shares, which is a new concept that M1 and some of these new companies have pioneered, is that you don't have to, if you buy an individual stock, just buy, let's say, one entire stock of Google, you can buy a part of the stock of Google. So I keep saying the word fund, but what is a fund? A mutual fund was invented in the 1800s, and it's a way to pool money to buy multiple shares of a company. You make one purchase and you own a part of a bunch of companies. It was really designed for convenience and diversification. Imagine trying to diversify like what's in the S&P 500 without a fund. You'd be buying 500 different stocks, which would get crazy and just impossible to manage. And the real benefit is if one stock crashes, it can be bounced out by another one improving, and you ride the fund up and down as it goes up and down with your returns. Traditionally managed by an active manager who picks the stocks, but you pay a price for this, which would be 1% to 2% of your portfolio. And does anyone know who this is?
I'm just going to take a guess, but is that Bogle when he was younger?
That is. Good guess. That is Jack Bogle, founder of Vanguard. He was sick of those darn fees. He essentially said, let me remove the fund manager and follow a fixed formula that tracks a known index. And the first index fund was created in 1970 to mimic the S&P 500, which charged an annual fee of 0.04%. So what does the word index even mean? It's a mathematical average that tells you how the stock market is doing. And an index can be extrapolated to anything. Example, if you weighed 10 friends and calculated the average weight, that would be an index. As the weight goes up in the group, the index goes up. As the weight in the group goes down, the index goes down. So the S&P 500 is an average of the top 500 US companies expressed as points. So as the market goes up and down, you'll see the S&P 500 go up or down. Most countries have their own indexes, and these are really the 9 major indexes we see. There's many, many indexes. You have the S&P 500, which I mentioned, the Dow, which tracks the 90 largest companies in the US. NASDAQ is similar, mostly tech companies. You have the MSCI World and Emerging Markets, S&P GSCI Commodities, which tracks things like gold, oil, gold, and even cattle, surprisingly. The Dow Real Estate Index, which tracks the real estate market. The Dollar Index, which correlates well with the US dollar strength. And then this VIX index, which is known as the Fear Index. It tracks the environment, the investing environment's pull towards investing in risky assets like options, the volatility of the market, and the uncertainty right now. So if you see the VIX go up, there's an increased demand to bet against investments. And people say it may be predicting a crash, but there's a lot of thoughts on what to do with the VIX, but it's essentially called the fear index based off how it moves. So if you put two and two together, you cannot buy an index in a sense. It's a mathematical average, but you can invest in an index fund that essentially is a combination of stocks that we call it tracking an index. So you're buying a culmination of all of these stocks turned into an index that if it goes up, your investments go up. If it goes down, your investments go down with it. It removes the idea of picking stocks like a horse race. You're buying all of them or anything with inside of it. And if one horse loses, who cares? The other one that wins will offset it. If the whole thing goes down, your portfolio will go down. But, as we were talking about, that's based off time and trends, likely not the case long term. It'll always sort of average itself out to the mean. So active versus passive stock investing is really where this collides at, in that active managers used to manage funds and they've shown failure, and they still do, but they've shown failure against passively managed funds year after year. And SPIVA is this study or comparison or scorecard that happens every year where they look at active funds versus passive funds. The ones that are tracking these indexes versus active managers just handpicking, oh, I think this one's going to win this year, or this one's going to win this year. Over a 15-year period in 2018 in their study, large cap just means large companies. Only 8% of active managers outperform the index. Middle companies, only 7%. Small cap, only 3%. So unless you're insider trading, active managers can't figure out how to get you ahead of the weight of the market. And this is it broken down even further, in that if you look at the blue is percentage of funds that outperform their respective benchmarks, less than, maybe 10% on most of these, even less when you get to large cap core funds here and even real estate funds here. So for the majority of the time, they're going to underperform a passively managed fund. Passively managed funds are also more tax efficient. Less turnover within the fund means less gains exposed to capital gains taxes, especially in a taxable account. The active manager may pull things out, they may sell things, and that will induce a tax burden on you. Expense ratios are minimal, which we'll talk about in a second, and it takes away the emotional component of it, also removes the gambling and turns it into math versus individual stock picking. So I keep also mentioning what an expense ratio is, and in simple, it's a yearly fee or cost on owning your investment. So an average active mutual fund, let's say you hired somebody and they're managing, they're going to charge you 1.5% of your entire portfolio. That's 600,000 times 0.015 here. They're paying them 9,000 a year, which will be lost to compounding. If you invest in an index fund or ETF, that's $240 a year, because let's say for the Vanguard Total Stock Market Index Fund, 0.04% charged annually. So if you save $1,000 a month for 40 years at 10% interest, compounding at 0.04 expense ratio, you'll have $558,842. But if you save $100 a month for 40 years at 10% compounding interest at 1.5% expense ratio, you'll have $370,952, which is a huge difference. That fee in itself will cost you $187,890. And that's why it's important to understand this, because I feel like a lot, and maybe it's not the case anymore, but there's a lot of predatory financial advisors and investment advisors that will go after healthcare workers to actively manage your money, that you'll constantly underperform because of these high fees and expenses. And it's really not hard to manage this yourself. And it's something that'll save you hundreds of thousands of dollars. A lot of guacamole from Chipotle. So you definitely want to save that money. These are the top US stock index funds that track US stocks. And just an example of what their expense ratios are. I mentioned the Vanguard Total Stock Market, 0.04%, the Schwab Total Stock Market, 0.03%, Fidelity came out with this new zero total stock market index fund a couple of years ago, and it's really cool. I haven't transitioned a lot over to it, mostly because I have a lot in just the regular Fidelity total stock market, which it is a little bit minimal of a difference here, but it's still important because it's still performing pretty well, and the expense ratio is 0. So, and it tracks almost the same thing. Something to consider if you have not invested in, and you have Fidelity in a total stock market index fund. And then you have Wilshire here, which has a little bit higher of an expense ratio. And then we get to the concept of WTF as an ETF. I mentioned that also. What is that versus a passive fund, index fund? Well, they're similar. They're introduced about 15 years after the index fund, and it turned an index fund into a tradable asset that you can trade like a stock. So it still tracks an index, but you can sell it throughout the day. Great for day traders, not great for us long-term investors, versus a traditional index fund, which is sold once a day. And it can get even more specialized. Let's say you want to buy one that just tracks cannabis stocks. This is sort of the benefit of an ETF, is that they can get very granular. So if you compare VTSAX, which is Vanguard's total stock market index fund, versus their VTI, which is their Vanguard total stock market exchange ETF, they're very similar. You're not going to see much huge differences here. Expense ratio is a 0.04 to 0.03. There is a minimum investment with some of these more passive index funds versus ETFs. These mostly just work on the share price. As I mentioned, they work like a stock. This is really where it changes a little bit, because the prices for a ETF are real-time pricing, and they're traded throughout the day. They change throughout the day. So you can only really buy a index fund at the end of the day, where you can buy an ETF all day. And there's a lot tighter control here, which you can have, because you can buy, you can sell, you can, track where it is. And with the total stock market index funds here, or the passive index funds, you can't do that till the end of the day. And some ETFs are more tax efficient than mutual funds or index funds. So for a mutual fund, they issue a yearly distribution with capital gains at the end of the year, which doesn't really happen with ETFs. But that's only usually an issue in taxable accounts, and not really an issue in your Roth IRAs or your 401ks, and also an issue with active managed funds. It does happen, though, that the way VTSAX was designed, it's called heartbeat trading, which is patented by them. It makes them, that and VTI, essentially equivalent in the tax benefits. So this sort of, when it's argued, it depends which ETF and which index fund you're arguing about. The way Vanguard designed it was that there really would be no difference tax-wise. So in summary, the pros of an index fund is diversification, reduced risk. You buy the huge variety of funds, and you don't need to reinvest in increments. And you can automatically reinvest. Access to low-cost options. Cons, minimum investment, not as tax efficient sometimes. ETFs provides a huge variety of funds, tracks an index, could be beneficial if you day trade. Entry fee could be smaller than the equivalent index funds, so sometimes you have to start in the ETF and then move into the index funds. And for cons, it's more work, not beneficial for the long-term buy and hold investor. You're more likely to panic sell. Transaction fees can be higher, and you actually can't do automatic reinvesting like index funds. So if you want to set it and forget it, your ETF is not going to be your friend. So I believe for us trying to reach our goals with long-term investing here, ETFs aren't really that beneficial. I think you're just as good buying a passively managed index fund. So then you hear about a target date fund. What is that? So it's a mutual fund that targets a date of retirement. Usually targets an index just like an index fund, but they track multiple indexes within a fund. It's a fund within a fund. So if anyone remembers that from inception. The percentage allocation of stocks and bonds change based on your planned retirement year. So if you have something that's target date 2055 and you buy it today, the stocks will be higher than bonds, but change over time based off whatever was designed to get you to a less volatile place in retirement, i.e. more bonds. Automatically does this. This doesn't mean it automatically invests for you, which you can set that up, but it automatically changes the allocation within the fund, US stocks, international stocks, bonds, cash, and debt. And the pros are they're good for some that don't want to do as much work and constantly reallocate funds. Still tracks a strong index. Returns are generally good, beating inflation 6% plus. Cons, expense ratios are usually a little bit higher. I'm not talking much, 0.12% versus 0.04%. Still better than an active fund, but it does not usually beat someone who's rebalancing on their own, as target date funds tend to be less risky too early in life. And you're not really looking at the market, seeing where things should go, where you should change your allocation, really thinking about how much volatility you want to put into the market right now, which is good for some, don't get me wrong. Others may want a little more involvement. And essentially will not get you the best return if you want to, this should say retire before that date. So it's set to get you a good position for that date of retirement. But let's say if you want to reach that FIRE or financial independence earlier than that date, you have to think about restructuring your portfolio a little bit differently than that. Maybe more of a portfolio that gets you more passive income, higher dividend yield, maybe more aggressive into stocks right now, and then transition maybe at an earlier or later point in your life. Depends on how long you want to keep working. So if you look at this is a US target date fund 2040 and a US target date fund 2020 compared to the S&P 500 this year. There's no question on the returns here, but that is mostly because of the amount of volatility and stock investing in this S&P. It's all US stock, while there's a portion bonds, REITs, debt in here, especially this 2021 is probably mostly bonds. So that's good for some people. And it just depends where you are, what year you are, what age you are, and what your plan is. So what if I cannot find these investments within my workplace plan? Well, you open a Roth IRA, no excuse to find these good low-cost funds with low expense ratios. Check if your workplace plan has an equivalent. They often do. You can often open them up, whatever the equivalent is, and look at like Vanguard's or the ones I've mentioned in here and see what's the expense ratio. You really want a sub 1%, ideally less than 0.1%. And then when possible, try and activate a brokerage account linked to your workplace account. So for those at Vandy, I don't know if you know we have this. I did this at Georgetown also. It's what's called a brokerage link. So as soon as I got here, I opened a brokerage link and dissociated, in the sense, the investments that they gave me into all of Fidelity to invest in anything I wanted. So the money funnels into Fidelity, same match, but then it goes into this brokerage account, which I can invest into anything that Fidelity has. Some places have this, some places don't. Transfer an old workplace plan to your new one, or open a self-directed IRA, which we'll talk about at a later time. So this gets a little trickier in a sense too here. So what's a good asset allocation? And that's different for everybody. As I mentioned, it's based off your risk tolerance. There are some reasonable ones and unreasonable ones. And the key is simple is better. Traditional rules have stated that your stock allocation should be 100 minus your age. So for example, if you're 25, you should have 75% stocks. If you're 65, you should have 35, with the rest being bonds. Benjamin Grant has advocated that you should never be over more than 75% of your portfolio in stocks, and never more than less than 25%. But this will change based off where you want your other investments to go. And as I mentioned, I've never been through a bear market. I'm a new investor, but those say you've not really understood what your risk tolerance should be unless you've been through a bear market and a crash. And it's easy to say, I want to be 100% into stocks until your entire portfolio levels out to losses of 60, 70%, like in 2008, or when REITs dropped to 70% in that year, or the Great Depression dropped more than 90%. What do you want to have in there that will balance you out emotionally and your portfolio to see that you're still getting decent returns to make it through that, to when you get back into a bull market, you'll be good again. So the white coat investor says you should expect to lose 2 to 3 times your money during your investment career. That's only a problem if you sell at lows. If you panic sell, that money's gone. If you keep it where it is and you continue to buy, there's no problem with that. So the other question becomes, how much international exposure do you want? Investing in international index funds help diversify, as when US stocks are generally down, international is usually up. And most experts recommend anywhere from 10 to 20% of your stock position. The other question is tilting versus buying the total. So what this means is one approach is known as just total diversification, where you buy 3 buckets. This is a very simple way to think about it. You buy 1/3 total stock, 1/3 total bond, 1/3 total international. Easy. Other way some people argue is called tilting, is you buy subclasses of those investments to try to beat the market, to push your returns a little bit higher. And the ways you can do that, if it's in the stock realm, is emerging market funds, which are just a new emerging markets. They're more risky. Value stock funds. These are stocks that are new. These are companies that are very new. They're not worth much yet, but you're betting on them getting better in the future. Growth stocks. This is your Amazon, your Google, your Tesla. These are doing great right now, but you're really just buying that already in the total stock. Junk bonds are just bonds that are rated very badly based off paybacks and consumer reports. I bonds we mentioned are from the federal government that pay based off a fixed and a variable rate based off inflation. And then you can buy even individual components, I mentioned, of the total stock if you want to, let's say, bet that the smaller companies will do better in the future. Smaller, and you can combine the two and say, I want to buy small companies that are in the value range where they're very new and they may be worth more in the future, or small growth where they're smaller but they're actually doing pretty good and growing, and combine a variety of these to try to get you to a rate that's a little bit higher than what you've been seeing based off what the S&P is tracking, or a combination of the total diversification here. And this is an example here of that, where it's 25% total stock, 10% value, 25% total international, 10% emerging. You can do any combination of this with theoretical high returns and higher risks. The arguments go back and forth on this. Paul Merriman is a big advocate of this. People argue, especially him, that small value has traditionally outperformed large growth over the market history. But if you actually look at it right now, that's not the case, because growth is consistently outperforming in the last couple of years. And you're really betting that value will do the same thing as it's always done, come back to the top. And these other things too will come back up and overall average your portfolio with higher returns. I think it's reasonable to take your stock portfolio and micro break it down into some of these. Let's say you're investing in 60% total US stocks. You can maybe say 10% of that is small value, but do your research first. The White Coat Investor has a great blog post on this, which I'll post here afterwards and then put on the YouTube page and send it out through email. And he has a whole new blog post on just everything I'm talking about: how to pick your asset allocation, what are the average returns nowadays, how to think about where to put each of these things in. And he really gets into some of his portfolio examples, which is on a very old post of his, what makes a reasonable portfolio. Because you could have something like this, which is relatively aggressive with a tilt to some small and alternatives, which if you add up the stocks here, it's 60% stock. That's made up of US stock, small US stocks. He just wrote that, but I'm not sure if he meant value or growth, but any variation of that. International, which, like I was mentioning, anywhere from 10 to 20%. You can even do a small international. And then these are your alternatives, your golds and your REITs, which are 10% here. Your TIPS, that's your treasury inflation protected bonds, and then total bond market fund making up a 30% bond portfolio. This is a very reasonable portfolio, especially if you're in your late 30s, 40s, and you really want to have not as much volatility as owning a lot more stocks than this, or you want more alternative. But there's also more of a conservative and simple approach here, where you're more into bonds maybe as you get a little bit older, closer to retirement. So my passive portfolio, and these things change every year, that's why you have to look at it, is right now I'm 80% total stock, just based off how the US stock market has been doing. 70%, 10% international. I did look at it. I think I own 1% small value, which I may look at it and may increase later. But I think for now, I'm mostly just more of that simple portfolio, 5% bonds for now. I'm more into alternatives. So passive note lending to real estate investors, syndication eventually, crowdfunding, REITs. And this will increase over time for me. And this is not even including the active component of buying rental properties. So I completely separate just where my passive component is going. But overall, I like to keep it simple. And I wanted to show everyone this portfolio tracker, which I'll send out also. Let me get out here. So this is from Physician on Fire, and I've been using this now for the last 4 years. And I will also put at the end of this the link. Let's see here. You could do this in Personal Capital, but I have found this to be amazing in the sense of easily once a month, probably less than an hour or so. You can even do it maybe more frequently than once a month, reallocating your portfolio. And the power of this is that you can take all of your accounts and combine them into one Excel sheet. So I'll show you, this is an example of his right here that he just has a downloadable version. You put the asset name here, total stock, the ticker symbol, which account, it's already programmed in to what you put down here. So you can see the total balance of it and what percentage is within that account. So he has the taxable here. And you could put the price per share, shares. I always just put the value. And this is something that you may have to look up. You may have to go on Fidelity or Vanguard's site to see how much is a breakdown of the fund. It's easy here. Total stock US, 100%. International, bond, alternative, cash, for example. Real estate is an alternative investment. And the expense ratio you put in manually here, and it actually gives you the annual cost that you are paying to own that amount of value. So to own here 397,000, he's only paying $158 on that because of this low expense ratio calculated out. And if you go it combines everything down, you'll see your total value here of your portfolio, overall percentage, overall expense ratio averaged out, annual cost overall to manage that entire portfolio. And this is really cool down here because you can set a desired percent like I just set. So 80, 10, 5, 10, 15, and it will actually tell you where you are based on that desired percent, how off you are from that, and it'll give you the amount that's discrepant. So let's say, January 1st comes and you have combined everything into this one Excel file. You could say, okay, I have some money that's put into from Vanderbilt or anywhere, my Fidelity account and the cash reserve account. Where should I put it? But it looks like there's a discrepancy of $1,000 in US stock based off what I want here. So it's easy. So you just buy that. And this is good if you have multiple accounts, especially old accounts, old 401ks, 457s, or if you're doing this with a spouse, you can combine all of it into one. So this is really a good way, I think, to keep track of everything, and it's coded pretty well. I mean, I haven't run out of room on any of this, but I think you can always use Personal Capital's way to see where you are in terms of your assets and liabilities and the overall percentages. But I believe that this is the easiest way that you don't even need a target date fund. Just do this once a month for like an hour or less, and you can rebalance your entire portfolio out to find the discrepancies and balance it out back to essentially where it needs to be. Any questions on that?
So there's tools with your personalcapital.com to kind of go through, see where your investments are and help you rebalance and say, what am I trying to get? Where am I at right now? Is that correct?
This is not through Personal Capital.
Okay.
This is through Physician on Fire. He's a physician blogger. You can do. So for those that have used Personal Capital, you can't do it as easy as this in the sense of rebalancing, but it'll show you at a given time where how much U.S. stock you have, how much international. But that's the reason I don't like using it, and I like using this better because you can easily rebalance and figure out where your next set of money needs to go. And I'm going to post the link to it to download. So next time, I wanted to talk about which accounts should you max out first. I didn't really want to include that today because I think it's a little more involved, and it's already been sort of an hour and 15 here. I'm sure you guys are tired, but I call it the order of operations. So it puts it all together. Where should you start? Roth, pre-tax, and which investments should go where? Because that does matter. Some investments have are more tax efficient, less tax efficient. Tax loss harvesting, I'm going to talk about that. And there was a request to talk about student loans earlier, so I want to get that in soon. And we can go back to these other things before or after that, such as Roth conversions. And even after that, we can get even more granular. But I think this is a good start of, I think, what I know and how I've been doing it. And we could always, depending on time for each of these, kind of just throw in things here and there. But I wanted to get through some of the big topics. Student loans I mentioned. Here are the resources again. And then disability insurance I want to talk about soon. HSAs, mentioned Roth conversions. Tax loss harvesting was in there. But that probably doesn't need a lot of time for that. Real estate. So that is something that for those I mentioned want to do more active investing in real estate, how I've done it. Not much, just one or two properties, but what I look for, real estate passively, and how note lending works. If you want to add that to your portfolio and try to get some of those returns we were mentioning that beat inflation. Student loans, big topic. Taxes, travel hacking. Just went to Jamaica for free, so flight was paid for. Anna, my wife, went for free with me as a Southwest Companion Pass. All the hotel was free based off travel points, and we can talk a little bit about that. Wellness, tax shelters, LLCs. Not too familiar with a lot of those concepts, but I think we can maybe get somebody on annuities, life insurance, and I'd love to have some guests on here or any other ideas. And that's it.